Student, this video will be the first of the two videos discussing Learning Objective 2 of Chapter 6. For this one, we'll continue from the videos of Learning Objective 1. In video of Learning Objective 1, we discuss deductions for AGI. For this learning objective, we are going to discuss this deduction from AGI. Especially, these are itemized deductions or standard deductions. Because standard deductions are quite simple and straightforward, so we will focus on our discussion on the deduction from AGI for itemized deductions. Itemized deductions are reported on Schedule A of Form 1040. One item of these itemized deduction will be medical expenses. For this one, actually, you can reference example 6-10 on page 6-14. The medical expense deduction is to provide relief for taxpayers who have been burdened by health-related circumstances. Qualified medical expenses include any payment for the care, prevention, diagnosis, or cure of injury, disease, or bodily function that are not reimbursed by health insurance or are not provided through a flexible spending account. Most common medical expenses are 1. Prescription medication, insulin, and medical aids such as eyeglasses, contact lenses, and wheelchairs. Over-the-counter medications are generally not deductible. Number 2, payments to medical care providers such as doctors, dentists, and nurses, and medical care facilities such as hospitals. Number 3, transportation for medical purposes. Number 4, long-term care facilities. Number 5, health insurance premium, if not deducted for AGI for self-employed taxpayers, and insurance for long-term care services. Medical expenses for cosmetic surgery or other similar procedures are not deductible unless the surgery or procedure is necessary to improve or ameliorate a deformity arising from or directly related to a congenital abnormality, a personal injury resulting from an accident or trauma or disfiguring of disease. Transportation and travel for medical purposes. The following expenses are deductible for medical transportation and travel. Number 1, lodging while away from home overnight and transportation for receiving essential medical care. Number 2, automobile mileage. This one will be 24 cents per mile for year 2013, and you may want to check the update. It can go up or down depending on the decision of the IRS, or actual cost of using personal automobiles for medical purposes. This one, you can see example 6-11 on page 6-15. Meals and lodging at hospitals are deductible. Taxpayers must deduct the cost of actual medical care, whether the care is provided at hospitals or other long-term care facilities. For this one, you can reference example 6-12 on page 6-15. Medical expense deduction limitation. The amount of unreimbursed qualified medical expenses paid minus 10% of the taxpayer's AGI, reduced to 7.5% if one of the spouses is 65 years older or older. That will come to our limitation of deductible medical expense. This is what we call the floor limitation. If the amount of medical expense is less than the floor limitation, it is not deductible. High AGI taxpayers rarely benefit from this medical expense pay because of the floor limitation. Please reference example 6-13 on page 6-16. What about taxes paid? Number 1, state, local, and foreign income taxes. State and local taxes cannot be substituted with state and local sales taxes for taxpayers in state without income taxes such as taxes. So if you don't have a state income tax, you cannot claim a deduction, then you can substitute it with your state and local sales taxes. Number 2, real estate taxes on property held for personal or investment purposes. Number 3, personal property taxes that are assessed on the value, not weight, of the property. These taxes are part of the itemized deduction. For example, under your registration, you pay for your automobile. Some states, they collect this amount part based on weight, part based on value. So if for the portion that's based on value, that you can take this as your itemized deduction item. What about interest? 1, subject to limitation, individuals can deduct interest paid on acquisition indebtedness and home equity indebtedness secured by a qualified resident, principal or otherwise. The interest is deductible only for mortgage up to $1 million. Number 2, investment interest expense limited to the net investment income, excluding interest paid for personal credit card debt and personal automobile loan. So you cannot use that as your you cannot use that to pay for your personal items. This please reference example 615 and 6-15 and 16 on page 6-18. What about for those you may church contribution? For charitable contribution, donations of either money or property, it may qualify for charitable contribution to qualify charitable organization. These contributions are deductible, and you better keep a good record. For example, you have contribution of money. Cash contributions are deductible in the year paid. Providing services to qualifying charitable organizations such as driving or other activities are also deductible. For 2013, for each mile you drive on behalf of a charitable organization, it's 14 cents. And you may want to check the update each year when you look at this for the value of the taxpayer provided. Please reference example 6-18, page 6-20. Taxpayers may deduct the amount of the contribution in excess of the fair market value of the goods or services they receive in exchange for the contribution. For example, a fundraising dinner for foster children of Texas costs the taxpayer $100 and the dinner costs $40. The taxpayer might be able to deduct up to $60. You know, the amount payment for dinner and minus the value of dinner, 100 minus 40 equals 60, will be the charitable contribution. What about charitable contribution of property other than money or cash? Capital gain property. Taxpayer can deduct the fair market value of capital gain property on the day of donation and also exclude capital gain on gross income. Capital assets are number 1, investment assets such as stock, bonds, and land held for investment, painting, etc. Number 2, business assets. Number 3, personal use assets, car, valuables, etc. This one reference example 6-19 on page 6-20. Capital gain property, either tangible, personal property, and property unrelated to the charity's operations. These capital gain donations are not deductible if charity uses the property for a purpose unrelated to its charitable purpose. For this one, see example 6-20 on page 6-21. Ordinary income property. Taxpayers contributing ordinary income property can only deduct the lesser of the two. 1, the property's fair market value or the property's adjusted basis. These assets include 1, assets held less or equal to 1 year. Number 2, trade or business inventory. Number 3, business assets held equal or greater than 1 year subject to the depreciation recapture rule if taxpayer has sold the assets. Number 4, assets including investment assets and personal use assets with the value less than the taxpayer's basis in the assets or the depreciated asset. See example 6-21 on page 6-22. Charitable contribution deduction limitation. This one is actually important. You need to know this one. The amount of charitable contribution deduction is limited to a maximum or ceiling depending on the taxpayer contributed type of property, cash or capital, and the nature of whether it's a public or private of the charitable organization. Cash and property donation to public charity and private operating functions are limited to 50% of the taxpayer's AGI. Number 2, capital gain property donation to public charity and private operating functions are limited to 30% of the taxpayer's AGI. Cash and property donation to public charities and private non-operating functions are limited to 30% of the taxpayer's AGI. Finally, capital gain property donation to public charities and private operating functions are limited to 20% of the taxpayer's AGI. For this one, we may want to see example, Exhibit 6-9 on page 6-22 for a summary of donation limitation. AGI limitation application in sequence as follows. So which means you need to follow these step by step. Step 1, determine the limitation for the 50% contributions. Step 2, apply limitation to the 30% contribution. The 30% contribution limits is the lesser of 1, AGI times 30%, or B, or 2, AGI times 50% minus the contribution subject to the 50% limit. Step 3, apply the limitation to the 20% contributions. The 20% contribution limit is the lesser of A, AGI times 20%, or B, AGI times 30% minus the contribution subject to the 30% limit, or C, AGI times 50% minus the contribution subject to the 50% and contribution subject to the 30% limit. When the contribution is greater than the AGI ceiling, the excess contribution can be carried forward over 5 years before it expires and is subject to the same limitation for the subsequent year. The carryover contribution will be considered after the deduction for subsequent year. It is exhausted first. This one, please reference example 6-22 on page 6-23. And this will conclude our deduction from AGI itemized deductions portion of the first video of the learning objective 2 videos, and we will conclude our learning objective 2 in the second video of this learning objective. Please ask your question or post your questions. Thank you.